Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 15th of 2021. Please share a disclaimer for important information. As we get started this week, we'll touch first on the high frequency data that we received, compiled for us by our friends up in Chicago, First Trust, which we can see here. Staffing index on the upper left-hand corner, moving higher above the 2019 trend line. We know labor markets are tight. Also, labor market indicators are actually very strong right now, and we know that incomes and wages are moving higher as well. So that's staffing. Weekly retail sales. We see that those have been stronger and above the 2019 baseline. So again, the consumers putting their money where their mouth is. Consumer sentiment with strong household balance sheets is reasonably strong. People are concerned less about the Delta variant now, perhaps a little bit more about inflation, but they're certainly continuing to spend. Hotel occupancy levels are still a little bit below, about 8-9% below 2019 levels. You can see that they're kind of more befitting of a seasonal pattern. So we expect those to kind of normalize, and heading into 2022, certainly kind of look a little bit more like 2019. And then finally, on the lower right, we've got the open table restaurant surveys, and you can see that those does not have a 2019 baseline to it, but you can see that the numbers have been holding reasonably steady. Again, about 8 to 9% below the kind of below a moving average, looking out over a couple of years. Some additional data points here. We got TSA checkpoint data. This does have a 2019 barometer to it, so you can see here our delta relative to the pre-pandemic time frame is still below, perhaps in the 15% to 20% range below 2019. Some of this has to do with business traveler really being largely absent from this recovery. We've got a lot of consumer activity, people taking trips and getting out, moving about. Business traveler is going to take some time to recover, and there is, I think, worthwhile speculation that there is elements of business travel that just simply won't come back because people have proven that they can be more productive via a virtual environment. And then over on the right-hand side, supply of motor gasoline in the U.S., that is back up to, and has been for some time, kind of following that pre-pandemic trend line. We did find, certainly during the summer, that people were on the road a lot, and this does have a little bit of a bump in the middle months. When you have better weather, you tend to have more road miles and things like that. So again, that's kind of following along its trend line. Now we'll pivot and talk about inflation a little bit, and there's various different data points that we have to show you this week. This one I thought was interesting, and it just shows you the inflation characteristics across several countries. And so I showed something like this a couple of weeks ago that gave you kind of a Eurozone view, as well as maybe an Asia view, and plotted that against the U.S. So clear to show in this slide that that inflation is not a U.S. phenomenon. We have certainly seen a lot of it, but supply chain choke points are impactful across the entire globe, and so we do see trends that are very consistent across the globe. And Canada, you would expect, because it's a major U.S. trading partner, so it's going to see some of the same influences that we do. UK and Germany, which is I think a fairly good proxy for the EU, showing very similar trends there. All right, so here is the consumer price index, and we've got some CPI and some PPI, which is a producer price index. And both of these indices, as we know, have been higher lately. Now, we did get a consumer price index, CPI, print this week, and it was ahead of expectations. So survey called for 0.6% in 1 month, and we wound up getting 0.9%, and then the core number was also higher at 0.6 versus 0.4 was the estimate. And you can see that red bar on the left-hand side for each of those components, how that stacks up on just a purely monthly basis relative to recent history. And you can see that it really stacks up quite nicely in developing that theme that we're seeing somewhat consistent month over month, higher than trend line inflation numbers, and particularly on the core side. And if you look at core on a purely year over year, not the monthly data points on the left-hand side, but a year over year number, where that sits right now is 4.6. And so that obviously puts a lot of pressure on real returns, that being higher, and we'll see that in a minute, the impact on real returns in the fixed income market. I thought this was very interesting from Pantheon Macro. What they do is they look at the core CPI or Consumer Price Index basket, and they isolate the variables that have been extremely sensitive to COVID. And these have a lot to do with the service industries and hotel prices or hospitality prices, restaurant, and other things that have been impacted more so by COVID than other areas. And you can see once they back that out, what you can see is that we're obviously not exhibiting the same type of inflation year over year that we just saw in our last slide, which showed us 4.6% year over year. But it is still meaningful, and it's still above the prior trend line. So we're pushing above 3% if we back out the COVID sensitive component. So when we talk about transitory nature of inflation, we have to be cognizant of the fact that there are inputs that have been COVID impacted that are pushing inflation higher, but there's still underlying trends in inflation that are being impacted here. And so, when you look at it ex-COVID sensitive components, I mean, we're still moving meaningfully higher, and moving meaningfully higher from the point that we were at literally at the beginning of this year, and certainly relative to January a year ago when we were just on the front doorstep of the pandemic. Now we dig a little bit deeper into the inflation picture here. On the left-hand side, we've got a plot of the U.S. Schiller Home Price Index versus the Consumer Price Index for shelter. And when we say shelter, this has a strong connotation towards rents, and we know rents typically move in response to prices at a lag. And in this particular chart on the left, it actually shows the shelter, which is in kind of that blue line there against the home price index, which is in the red dotted line. But the blue line is lagged at 18 months. And you can see that there's a really strong relationship here. And as we see home prices move higher, from a lag standpoint, we would expect to see rents move higher. And in fact, on the right-hand side, you can actually see that that's beginning to manifest itself. And so this is something combined with wages, as it relates to the overall inflation picture, which I do think is going to be sticky. And once you get rents moving higher, and again, if you assume that we're at a lag and home prices maybe don't accelerate as much in 2022 as they have this year, you're still going to get that lagged effect of rents moving higher, and that's going to be sustaining. So, if you assume that rents, which are in the core CPI and shelter, which is, over 30% of the core CPI index, are going to continue to move higher next year, then that kind of debunks a little bit this theory that we're going to have, all of this moderation in inflation. I think this part is particularly sticky and will keep us at a higher level of inflation that we have been accustomed to over the last several years. Here's something, looking at things in total, I guess, obviously we've seen a huge surge in new vehicle prices. A lot of this has to do with the supply chain choke points and the inability to actually get product out the door because of the semiconductor shortage. And so we've seen a huge bump in new vehicle prices as it relates to the consumer price index. Now, what's interesting about this and this has a lot to do with COVID, in one of those COVID sensitive areas that we saw a couple charts ago, that when the supply chain system does get worked out and the issues moderate, you can actually see a deflationary impulse from new vehicle prices. As they kind of normalize, you could see prices actually moving down from these lofty levels and have, as I said, a deflationary impulse on inflation overall. And as we talk about inflation, obviously we got to go back to the bond market. I've always looked at the bond market as a reasonable harbinger of, kind of things to come. It does a better job of reading the economic tea leaves than does the equity market, influenced by different factors, so on and so forth. But what we've seen in response to the inflation number, particularly the CPI number, is a fairly strong and continued response in short-term government bond yields. And the upper left, I've got the 3-year bond yield, which is a reasonable proxy. Again, it's not near term. It is looking out a few years, and you can see that those numbers are being influenced now. And if you look at the 30-year minus the 5-year bond spread, so basically the yields on the 30-year Treasury minus the yields of the 5-year Treasury, you can see that the curve is really flattening out, as long-term inflation isn't really budging that much, or excuse me, long-term rates are not really budging that much, but you're seeing shorter-term rates kind of moving higher. And that's clearly been a trend that we've seen all year long. And I think these spreads are going to remain low. Now, typically when you see fairly low spreads or, a very flat yield curve, that doesn't necessarily, imply a tremendous amount of economic growth. And I think the story that is being told in these charts is the fact that we're going to have slower overall economic growth in the next year or so than we certainly saw last year. I don't think that's any surprise to anybody, but you're seeing it kind of be borne out in our yield curve. And on the right-hand side, you've got the 10-year break-even rate. So this is essentially the difference between the Treasury inflation-protected security, the TIP, and the 10-year U.S. Treasury. And the difference between those two yields is the implied inflation rate. And so, as you can see here, the bond market, now is essentially interpreting a 2.7% inflation rate, kind of over the next 10 years. And that's obviously higher than we've had it. But if you go back a long, long time, even though over the last 20 years, 25 years, we've had a secular decline in overall inflation rates. But if you go back a much longer period of time, that average is about 3%. So we're still below an extremely long-term average. But as you can see here, the bond market, as it interprets future inflation, is clearly expecting higher inflation going forward. And continuing on this theme, as we see these inflation prints, you're getting increased probability of multiple rate hikes next year. And at one point, not too long ago, literally about 3 months ago, there was a very strong likelihood of not having a rate increase in 2022 at all. Now we've got basically almost an 82% probability of 3 rate hikes in 2022 in response to what you're seeing in inflation. And that would be a pretty profound move relative to what we've been used to. And so it moves interest rates higher in response to inflation expectations and observed inflation. I think the world is beginning to position itself to a higher interest rate environment, which I do think will take some of the froth off the equity markets and make the equity market multiples a bit more expensive relative to their levels when we had very, very low interest rates. And as we continue to watch interest rates and build in this expectation of higher overall interest rates, we have to think about the dollar too. And so generally when rates move higher in one country relative to another, that country's currency tends to strengthen. Now we've already seen that here. And this chart shows you a fairly limited time series, but going back to October, and it's really kind of getting back to those levels that we saw about a month ago after a little bit of weakness. So I don't want to get caught up in the near-termness of this because this data is only showing us 1 month of data. But I do think it's important to conceptualize this backdrop where we have a stronger dollar because interest rates are moving higher. But having said that, we are seeing a lot of central banks around the world increase their rates. And so I think, the probability of having like a real big breakout in the US dollar is less just because you've got foreign central banks that are also raising rates, but perhaps a little bit more aggressively and sooner than the Fed is expected to. And even though this chart isn't labeled, it's showing us gold. And so gold has been a little bit higher. We've seen a bit of strength over the last month. Some of this has to do with interest rates. Some of this has to do with inflation. Gold is typically a good hedge on inflation. And so you see a little bit more demand out there and volume in the ETFs and whatnot. So we have seen a little bit of strength in gold. And getting back a little bit to this conversation of supply chain choke points and whatnot, I thought this was really interesting from Bloomberg and Gabe Call. And what it shows you is a plot of literally the number of vessels at port waiting to dock at the port of Los Angeles. You see that number has moved higher rather dramatically. Even as recently as July, there were maybe 20 container ships that were ready to unload. Now there's over 60, roughly 60. And so the red line shows you that superimposed here is basically the truck demand index. And we have seen some uptick in hiring in trucking. We'll see that in a second. But we're seeing truck demand numbers be really challenged. And so that what that tells us that once we get the ports opened up, we could still have a supply chain choke point of just literally not having enough drivers and not having enough trucks on the road to transport what's coming in through the ports. And here's that chart that I mentioned with regard to payrolls. And again, if you look over a multiple year time frame, you can see the general trend is up, but then we've been struggling to get back up to our pre-pandemic levels. And this is average employment in trucking. So we're still at a deficit to where we were before the pandemic. And this is going to be important. So we need to close that gap. As I mentioned on the last slide, when the ports begin to clear up a little bit, we'll have to have overland trucking that's going to support the product coming off of those container ships. This is a chart of inventory to sales on durable goods. And so what we've been talking about really over the last several months has been this conundrum where inventories have been depleted because you can't complete product because of semiconductor shortages, supply chain issues where you can't get raw materials, and so on and so forth. And frankly, inventory depletion was a drag on economic growth. It is one of the four major components when you think about consumption and investment and government and net trade. I mean, it's a component. It's one of the primary inputs and primary swing factors, frankly, into economic growth. And so that number's been fairly low lately, but as we see here, that number's beginning to tick up, which is actually good. So it just means that for the amount of sales that is taking place in the durable goods area right now, we're seeing higher levels of inventory. So the production chain, maybe this is symptomatic a little bit of some of the supply chain issues beginning to kind of peel back, but nevertheless, it's a positive sign overall. Now we'll talk about labor for a second, and what's really interesting is we kind of get towards the end of 2021 here, that just from an initial jobless claim standpoint, we're actually getting very close to our pre-pandemic average. The average over the course of the entirety of 2019, you can see the gradual trend downward has been, I think with a couple of exceptions, has been fairly smooth and consistent. And particularly the last 6 reports that we've seen have shown quite a bit of strength in the labor market. Here's another element of the labor market. We've talked about high quit rates amongst employees, in fact, a lot of younger employees, and we've also seen a lot of retirements out of the older age cohorts. Here's some data here that shows us just how tight this labor market is. On the left-hand side, from the Bureau of Labor Statistics, you've got a survey trend line here of folks that are interested and want a job now, and that number is sliding down. So even though you've got a situation where you've got more open jobs and you have unemployed workers, you've got a deceleration in the interest in wanting a job now, and that is despite the fact that a lot of these pandemic era benefits, unemployment benefits, have ceased. So it's a very interesting dynamic right now. On the right-hand side, you've got really several different things that are being measured. And again, just like the headline of this particular chart from GaveCall shows, I mean, there's no more surplus of cheap and eager workers. You can see the bottom chart there, you've got employment costs, which are clearly moving higher, and you can see that very, very clearly on that chart. You've got people in the middle here not in the labor force who want jobs. That number is going down, and this is 16 and over. And then the temporary unemployment rate at the very top, kind of working bottom to top here, that's also down too. So it's a very interesting dynamic. Costs are moving higher for wages. The urgency of getting a job is going down, and the interest level in working, and people not in the labor force that want to get back into the labor force is actually gone down as well. So we have labor force participation, which is now moving a little bit lower at a time where retirements are high and the demand for workers is increasing. So we'll have to monitor this for sure. So a couple of things here on e-commerce. We absolutely know on the left-hand side, you can see that very clearly that during the pandemic, people that were sequestered at home that were buying online, and so that number spiked, and probably not too surprising, but that number continues to move higher at a pretty accelerated pace. And I've got a chart at the end on holiday buying that I think will be pretty interesting with considering this as a backdrop. Now, what's interesting as a result of this, and we've seen some major announcements like Amazon that wants to hire 100,000 workers, and then we've got other delivery and small regional freight folks that are trying to hire a lot of people. You can see that on the right-hand side. So this is employment for couriers and deliveries as well as warehousing. So this drive in e-commerce is actually having this kind of intended, in a way, benefit on employment in these particular sectors. And again, we know that e-commerce sales have been moving higher every year, since e-commerce was became a thing, but it's really accelerated during the pandemic here, and so I think this will be a major source of employment going forward. Now, I came across this chart in Bloomberg, and I thought it was interesting. It underscores something that we have been talking about. We know with high prices for homes, the residential housing sector, that coupled with the fact that for pretty solid credit levels for consumers, you're able to get refinancing for that. We've seen the refinance index be pretty high with low rates and good credit. Those folks are able to do that. And what this chart tells you is just how much equity they're taking out of their homes. And so, when you think about this and the economic benefit, it's not insignificant. We're talking about, $60 billion on an annual basis. And that number is up considerably, as you can see here, from just a few years ago. And so that money is being put into home improvement. People are building pools. They're expanding homes and finishing out homes. And so you see a lot of consumption as a result of this. This is money that is, that has, that would otherwise have very little velocity because it's just pent up equity value in one's home, now be monetized and then actually provide a multiplier in the economy in terms of secondary spending. Now we'll start to talk about here the investment markets a little bit more. This is the S&P 500 real earnings yield. I saw an article by Liz Ann Saunders of Charles Schwab, and she pointed this out. I mean, we're at, the real earnings yield for the S&P 500 is negative 2.3%, and that's below the record previous low in 1974 of 2.1%. Very profound here. This is just showing you that for every dollar, of earnings, if you inflation adjust that, then that yield is actually extremely negative right now. And here's just another look on the relative inflation picture. So this is a chart from the Federal Reserve Bank of St. Louis, and it shows you the 5-year U.S. Treasury less the consumer price index. And you can see the influence here that we've had this kind of secular decline in inflation over many, many decades now. And so you see that delta is actually straddled for some years now, the negative boundary, and now we're firmly in that negative territory. In fact, we're at the lowest level in terms of this particular data series that we've seen, since 2 different recessions back in, 75, which is, following the OPEC oil glut, and then 1980, which, as we know, was the precursor to a fairly strong bout of inflation, which was attacked in the early 80s by Paul Volcker, the previous Fed chairman. But you can see here now, we're in a post recessionary environment, and we're at those negative levels. So this is the producer price index, and we've talked about consumer prices for a while, and we'll just look at producer prices here. The October PPI, if you will, was pretty much as expected, about up 0.6%. Last reading, the September reading, was up 0.5%, and the year-over-year number is about 8.6. And obviously, we've talked about this a lot, whether it be lumber, some of the industrial commodities, some of the soft commodities. I mean, we've seen upward pressure net in all of these areas, but core PPI is still up 6.8%. You can see that is still, we've seen a huge move in a relatively short period of time. Now, again, going back and just reiterating the narrative that we established earlier in this chart pack. I think from a producer standpoint, prices do moderate here, but that's not going to get us back down to 2%. I think, producer prices are going to remain a little bit higher, and then this is, of course, notwithstanding labor cost inputs, which we know are going to be a factor as well. So I wanted to tie back this whole conversation with inflation back to the S&P 500, and we know that the S&P 500 is really just kind of plowed through this whole issue of inflation, and we're at all-time highs, and the question then becomes, where do we go from here? And there have been quite a few observable data points on these on this type of an issue, and so as we look at it, we know that if you look at 1, 3, and 12-month price changes, once you've hit a high, we can kind of tell, you kind of predict where the market's going to go. And you can see here that when you're looking out like over a year on a high, by and large, you're going to continue to have positive performance in the market. Again, if there's not a policy mistake, i.e. the Fed raises interest rates much too fast. If you don't have that kind of situation, then historically, you can make and build a case that you're going to have continued strength in the equity markets 12 months henceforth. And we mentioned this data before, but as we were talking about the probability of increased U.S. short-term interest rates and interest rates overall over the coming year or so, and I mentioned that the U.S. is certainly not the only country that's witnessing higher inflation and consequently higher rates. And I'd mentioned that other central banks across the globe are raising rates perhaps at a faster pace than even the Fed is. And this is a chart that kind of proves that out. And so if we look at 2020, you can see that there were 207 different rate cuts amongst global central banks, and there were only 9 hikes. Obviously, people were dealing with a pandemic, and there was a strong interest in wanting to make credit a lot easier. Well, in 2021 already here, and obviously we're not done with the year yet, we've seen a lot more hikes than cuts. And so this is just telling us that global central banks are moving ahead of the Fed, and probably ahead by the tune of 6 to 9 months. So we're talking about housing and taking equity out of one's home, because household balance sheets are really strong right now. Home values are up, so equity values are high. What's really interesting, and we see the data that tells us that the credit quality of a lot of these mortgages and credit quality of a lot of home loans is really high right now. In fact, this chart shows you the loan to value ratio in the entire U.S. housing market is at its lowest level in 35 years. And that is really profound. We did see a huge spike in this, during the liar loan days leading up to the global financial crisis. Even in the aftermath, there's a lot of, people struggling to get on their feet and, had to take on, had to bear higher loan to value ratios, but we see that number has really moved meaningfully lower. I mean, and this is pretty profound, a pretty profound trend that we've seen over the last several years. And this is a chart from Mizuho Securities plotting homeowner vacancy rates. And so what this tells us is, and you could see, after the global financial crisis in which vacancies went up considerably, that we've been working that vacancy rate down now to a point that, frankly, we have not seen in the observable time frame of this data set. I mean, we're at the lowest point that we've ever recorded here in vacancy. And so when you think about this, it provides a lot of confidence to builders to construct more homes. It tells you that the market for homes is tight. It confirms what we already know in this trend of prices, is that, frankly, it is a supply and demand issue. With vacancies going lower, the demand for housing is moving higher. Builders are responding, but not at a pace which is going to keep prices moderated. And as a result, we're seeing home price increases all across the board, which, as we just saw, has led to more home equity loans, more cash out refinancings as folks are doing projects. And so, there is an interesting benefit to the economy in terms of increased monetary velocity from all of this liquidity being freed up. But what this chart tells you too is this is not a trend that just established itself over the last year, that this has actually been going on for several years. And builders look at this data too. And so it tells you that home values are likely going to continue to move higher, albeit at probably a slower pace than what we witnessed over the last 12 months, but that this is a trend that's firmly established, in my opinion. A couple of charts here. Crude prices are off a little bit. I think, we showed you a chart in the charts of the week last week that at least from an OPEC standpoint, we know that they're under producing relative to their quotas, so that's kept prices high. But then, looking out into mid 2022, there's actually expected to be a surplus of crude. And so, we're just kind of following crude right now. Obviously, it's important because it impacts the cost and price of distillate products like gasoline. And we certainly know that people are paying more for gasoline now than they have. And that's another, input into the whole consumer sentiment side. On the right-hand side, you've got the dollar index, which is plotted against energy prices. And, usually you can say, weaker dollar is better for commodity prices. And in this case, you can see what's going on right now is we have a pretty wide divergence. We've got a stronger dollar, certainly over the last probably 5-6 months, at the same time, actually, that we have higher energy prices. And some of this is a recovery as production has kind of come back online to some degree, but still be below the level of demand. So it's just an interesting dynamic. Rotations in equity market leadership. This is really interesting. If you look at the different, size and style characteristics, you've got growth versus value, you've got large versus small, and then kind of tech versus energy, which is kind of emblematic of more kind of like, cyclical versus momentum. And what you saw in the aftermath, the immediate aftermath of the pandemic, where we hit our trough in March 23rd of 2020, through August of that year, we saw growth, and particularly tech, really lead the way. I mean, we had the kind of the Fab Five or the FANG stocks that were leading the market, and most of the rest of the index was really lagging behind. And then we shifted to a slightly different regime where technology stocks took a back seat, growth took a back seat, value really kicked in at the end of August through the beginning of March, and that was this feeling that we're emerging from the coronavirus, and as the first couple of initial waves kind of waned, that there was a real strong rotation towards the cyclically exposed stocks. Well, and then that kind of reversed itself as we got into the end of March through August. Some of this had something to do with the emergence during that time frame of the Delta wave. And so we saw growth again kind of reestablish itself over this period of time, and value, small caps, and energy stocks took a back seat. But what we're seeing right now since the end of August is kind of a resumption where essentially all boats are rising, but we're seeing that impetus coming from value. We're seeing small caps begin to perform. Energy has been exceptionally strong with higher energy prices. This is the trend that is likely to kind of persist overall, in my opinion, over the next year, as we are cyclically exposed. Higher interest rates are going to take some of the steam off of technology stocks, which in turn will probably take a little bit of the steam off of growth stocks in general. A couple of interesting charts here. We talked about corporate sentiment, which has been pretty high and has rebounded very, very well. We see that corporate sentiment with regard to inflation, labor markets being tight and supply chain issues and raw material inputs that are higher. We see that corporate sentiment is actually back down to second quarter of 2020 levels, and this is an index, if you will, and we have a lot of things that are weighing on corporate managers' minds. We hear a little bit of it, here in the earnings season, which is essentially concluded for us now, but we certainly heard those types of things. And so anyway, so we match corporate sentiment up with investor sentiment, which, not too surprisingly, is extremely high. Markets are doing well, and investor sentiment is actually extremely strong right now. All right, well, we've got a few more here left, and one that I wanted to show you is highlighting this container ship issue. This is China to U.S. shipping, and this is just essentially freight delivery times, and we already talked about there being in the port of Los Angeles, over 60 container ships waiting to unload. Well, you can see that the timelines here are really fouled up as well. So you think that we've gone from, like, in pre-pandemic levels, we were like 40 days of ocean freight time. Now we're at 73. That's like over an 80% increase in freight delivery times. And so that's translated to higher costs. Obviously, a lot of supply chain disruptions, because a lot of these things in container ships are eventually being, if they're not final produced items, then they're certainly inputs into what would be a final production stage. So this is just kind of putting into visual terms, this whole issue that we've seen about freight delays and supply chain disruption. I thought this was really interesting. This is for kind of the wonky left brain folks, but this is really a study that shows holiday sales plotted against the S&P 500 movements in that index from September to December. Basically, the change in the market and how it correlates to holiday sales. And as you can see here, there is actually a pretty good fit, meaning that if you have, in this case, like 5 to 10% move in the S&P 500 from September to December, that usually correlates into anywhere between a 3 and perhaps 10% increase in holiday sales. So it's not a perfect fit, but there is a reasonably positive relationship here, meaning that if we continue to see the S&P 500 grind higher here, then that would typically portend or translate into reasonable holiday sales performance, which is really what the market expects right now. All right, in our last slide, just want to bring you back to something that I alluded to earlier, and that was, when we were talking about e-commerce trends, and this is a survey from about 1,600 households from October 15th to the 25th of last month, and you can see here that the majority of folks will do most of their holiday shopping online. So again, to that notion of supporting the hiring plans for Amazon and some of these other shippers, as well as wages within those environments, all expected to go up. Well, that's all we got today. Hope you enjoyed our chart pack on behalf of the entire team at BKA. Hope you have a wonderful week and look forward to talking to you again soon. Take care.